One of the biggest companies in my portfolio reported earnings a couple of days ago, and after digesting the report a little bit, I'm actually considering trimming my position in that company. And in this video, I've prepared a little presentation around that earnings, highlighting exactly the numbers that concern me and my thought process around making a move like this. Of course, the company that I'm talking about is Revolve. They reported Q4 earnings on February 23rd, 2023, and I've talked about this company a couple of times before, all very bullish sentiment. In fact, Revolve is my third largest position, around 6% of my total portfolio, sitting right behind Tesla and SoFi, which unsurprisingly make up much larger chunks of the portfolio. Revolve beat on both the bottom and the top line. However, it was a much slighter beat than what is their usual norm, where sometimes they even double analyst expectations. The co-founder and co-CEO said that while the macro environment has become more challenging, the company has moved quickly and makes progress towards balancing inventory investments while continuing to deliver profitable growth. Now, just as an overall summary on Q4 before we dive into the numbers more deeply, net sales grew about 8% year over year to $259 million for Q4 compared to $239 million in Q4 of last year. Gross margin fell slightly, 339 basis points. Net income, this was a little bit disappointing, fell 73% year over year. 2021 was a pretty big comparable year for the business, and they were hit by tax rates as well. And we're going to dive a little bit deeper into this. And adjusted EBITDA, unsurprisingly, also fell 59% year over year. Now, zooming out from a full year perspective, net sales are up 24% year over year versus the 8% in Q4 alone, to about 1.1 billion in total sales for 2022. Keep in mind, Revolve is a company that has about 1.8 billion total market cap, so doing 1.1 billion in total sales is a pretty good number comparatively speaking. Net income, by contrast, fell 41% year over year to 58.7 million compared to the 100 million that they reported in 2021. Adjusted EBITDA fell 21% to 90.2 million. Now, in terms of the sales breakdown, I've talked about this slightly before in previous videos, but just as a recap, Revolve sells predominantly in the US. About 84% of their net sales happen in the US, with only 16% happening internationally. And of course, the US is also the geography where they are growing the fastest, up 9% in Q4 in the US versus 1% internationally. And really, with regards to this geography breakdown, there's two ways you can look at it. You can either say this is good because their biggest segment is growing the fastest, therefore it's going to accelerate their sales even more, or you can say this is bad because if they're trying to expand internationally, their international expansion isn't going that well. Now, there's two ways you can really look at Revolve data. Number one is by geography and number two is by segment, because Revolve has a secondary brand which is much smaller called Forward. This is their high fashion brand. It's a higher price tag brand. Breaking this out by segment for the fourth quarter and full year, we can see that Revolve, the core brand, grew 9%, whereas Forward only grew 5%. And in terms of gross profit, we can see that Forward was actually negative year over year, and the fact that Forward makes up a smaller percentage of net sales versus the core Revolve brand actually being higher gross profit for the business. In terms of the full year, similar numbers here. Revolve still growing faster than Forward, but it's definitely a closer race, 24% versus 23% year over year. And the segment gross profit tells a similar story with 22% growth in Revolve's core brand, a higher percentage of segment net sales, and Forward is only growing 12% year over year. Again, the similar ways to view it is their core brand is growing the fastest, or if you have the glass half empty view, saying that their secondary brand isn't growing as fast. Now, just for context, how this looks like from an absolute numbers perspective is the core Revolve brand contributes about 921 million in terms of that 1.1 billion total sales, whereas the Forward brand is just under 200 million for 2022 full year in terms of net sales, which means that Forward is still very, very small by comparison, which anecdotally you would expect that to be growing faster because they have more of a runway to grow. However, they are also a higher price tag brand, which also hinders their growth. Now, looking at some operating metrics, we can see that active customers is up 27% year over year. Actually, pretty good quarter over quarter growth as well for active customers. Orders placed is up year over year, about 11% up versus the 72% in 2021. You can actually see based on these metrics and also based on the revenue metrics how difficult a year 2021 was as a comparable year. Average order value, this is one of the numbers that I really loved about the report, was up 5% still to $306 average order value. Now, this is a number that's fluctuated quite a bit. As you can see here, the growth trend is a little bit up and down. However, the average order value being around 300, even above 300, is fantastic to see from the brand, especially considering that active customers is one of their fastest growing metrics. They actually reported a record active customer growth, up 27% in the full year, adding around 500,000 new members, bringing their total customer count to about 2.3 million members for the cumulative brands. Now, the interesting thing about active customers is that this growth rate is perfectly in line with what you can expect from Revolve's active customer growth. As you can see, 2022 is pretty in line with 2019, with 2021. And of course, 2020 was an exception because everybody was staying at home and Revolve is fundamentally a clothing brand. But if you eliminate that as an outlier and look at all the other years, 27% is perfectly in line with what Revolve is expected to bring in, with their highest member growth on the absolute numbers, of course. And that's even more important when you consider their retention rates and their average order value. So we already talked about the $300 average basket value. Forward's average order value is actually $690, which is insane when you think about it. Very premium brand on that front. And from a retention perspective, you can see that 2020 actually was their worst year in terms of retention, 74% due to the lockdowns. And the comparable year is 2021, which actually had 120% retention rate, and 2022 is coming in somewhere in between at 97% retention, still above the historical numbers pre-2020 levels, where pre-existing customers generated 79% of 2022 net sales and 50% of active customers for Revolve. So you're seeing that repeat business in terms of that retention rate for Revolve as a business. Now, let's get into some of the negatives around what happened with their bottom line, since all of their top line metrics seem fairly strong, all things considered. There's a couple of factors that play into their expenses. Of course, gross profit was a little bit lower as they had more markdowns. Basically, they made more discounts over the year. There was a higher year-over-year cost related to expansion of the fulfillment center footprint in the second half of 2022. So basically, they expanded their fulfillment centers, and that's how you have a bigger expense in fulfillment. Sales and distributions was also higher at 17.5% versus 15.9%. This primarily reflects shipping costs with higher year-over-year shipping rates and variable fuel surcharges, which were up year-over-year by 70+% in terms of the fuel surcharges alone. Now, those numbers definitely rack up for a business like this. Marketing expense was also higher, reflects an increase in performance marketing and brand marketing investment to acquire and retain customers to drive higher sales. Of course, with events coming back, that's going to contribute to the marketing budget. And general and admin was also higher, driven by an increase in headcount to support the growth and expansion. So all of these expenses, while justifiable as individual line items, when put together contributed to a much lower operating income margin for Revolve, 4.1% versus 13.3% last year. Now, in terms of their EPS breakdown, one thing that they really talk about was the effective tax rate, which increased from 7% to 24%, which actually negatively impacted their net income GAAP numbers. However, if you look at the income before income taxes was involved, the company is still down 67%. So taxes were higher, yes, but they only contributed to a very small difference in between these two numbers. So when you add up the shipping, when you add up the expenses, when you add up the tax rates, you get these kinds of income. This is definitely the most concerning number for me, the fact that income and margins took such a huge compression, because that's definitely not the trend that you want to see from an earnings per share perspective. Free cash flow was also down in a big way, 70% down year over year to 18.3 million versus 60.1 million in 2021. This is from a full year perspective. Net cash provided by operating activities was down 62% year over year. And even if you put these two together, it impacts their cash and cash equivalents negatively, which have been growing at quite a healthy clip. You can see this actually plateauing here, up 7% year over year to $234.7 million in cash. Revolve also has zero debt. They have a $1.89 billion market cap. In other words, their cash is around 12% of their total market cap. Now, when you talk about free cash flow, you can see that the biggest hit to that was the increase in inventory. And speaking of the inventory, it's actually flatlining, which is good because you can see since 2021, all the inventory numbers have been increasing. However, this has been flatlining. And this was one of my biggest concerns in my last Revolve video, which I made sometime in August, where I said we need to rein in this inventory increase, because if a business is increasing in inventory, that means that those products are not selling. And so that's just an overhang on the potential sales that they can have. And so the fact that this inventory was increasing up 26% year over year is definitely not a good thing to see. However, the guidance that they gave and what they said on the call, which I'll cover in just an upcoming slide, is positive because it shows that their inventory is flatlining and actually starting to decline. So just to recap, Revolve had a super tough year-over-year comparison. Margins contracted year-over-year as the business worked through their extra inventory. Free cash flow missed. They blamed the tax rate for this, but again, free cash flow and that EPS number weren't really good, even pre the tax rate. So the net income was down 40%. Gross margins affected this. Tough comparables, higher expenses, and the tax rate all affected this. They actually paid $18 million in 2022 taxes versus $4.8 million year over year. However, from a company health and balance sheet perspective, they do have a lot of cash on hand. They have $0 in debt. Their stock compensation is under 1%, and the founders actually own 45% of the company. And they've both been co-founders and co-CEOs operating the company for 19 years. So I think that it's a pretty stable thing to see from that perspective. However, the biggest concerns for myself was the inventory. The leadership on the call highlighted that the inventory was to be fully rebalanced and normalized by the end of the second quarter. This actually says Q2 here. I think my camera is blocking it. Inventory was $195 million as of the end of January. And the fact that they mentioned this on the call was very important for their guidance, but also for investor confidence, because inventory at $195 million already shows a slowdown. Because if you look at inventory here, it's at 215. So if we go down to 195 already by the end of January, then it highlights good progress in lowering that inventory even further. In terms of guidance, this is really where a lot of the strength came in with regards to Revolve's earnings report. They said that the quarter to date, so Q1 that we're in right now, sales growth is in the mid-single digit range year over year. So something like 5 or 6% year over year. However, the analyst expectations were negative 2.3% for Q1. They actually thought Revolve's business was going to contract. So definitely an outperformance compared to analysts on that number alone, expected to come in for Q1. Management highlighted on the call that growth could slow down in March, but it's still better than analyst consensus. They highlighted that they have significantly higher 2023 free cash flow versus 2022 as the inventory build reverts. So as they burn through some of that inventory, their free cash flow is going to improve, and a lot of their bottom line metrics are going to improve as a result of that. They're accelerating revenue growth throughout the year, which is good because 8% revenue growth is nothing fancy, especially compared to some of their previous numbers. Average order value growth is going to slow to around 2 to 5%, but like I said, anything around that $300 mark for average order value, I'm pretty happy with, especially because that has been slowly increasing over the years since I've been holding this business. Gross margin is going to bottom out in this quarter, so Q1 2023, at 49.5% and be at 52.5% for the full year 2022. Now, this is very good because if gross margin bottoms out, then that signals the end of that contraction, and we can move on to the other side where gross margin starts to expand again. Revolve is still outperforming their peers and industry benchmarks. So as bad as you think some of these numbers might be in terms of a contraction perspective, considering all of the factors that we know in terms of their comparables, their expenses, gross margin contraction, it's still better than a lot of industry peers, especially in the e-commerce space that they play in. So the main consideration, and probably the title of this video, is going to be something around selling or holding my position. It's been something that I've been thinking about, at least trimming my position, as I don't think I'll ever fully sell out of Revolve. It's one of my favorite companies out there. This was, in my opinion, the trough. If not this, then Q1 is definitely the absolute bottom in terms of what we can expect from a gross margin contraction perspective. I think that this is the hangover after 2021 was the surge. So the tough comparable period and the gross margin contraction all have a part to play with 2021 having been so strong. However, despite this, the results were better than analysts were expecting, and even guidance was better than expected going forward. My cost basis on Revolve is still quite low. It's in the mid-teens, and I've been holding it since 2020, I think even 2019. I'm considering trimming, similar to what I did with Etsy. If you haven't seen that video, then definitely check that out. I basically sold a portion of my Etsy position in the beginning of January to buy Tesla and SoFi, which so far has proven to be a tremendous move because both of those stocks have gone up over 70%, whereas Etsy, I think, has gone up at a much slower pace than that. So something similar for Revolve, just to capitalize on the momentum for some of my other more concentrated names. However, any moves that I would make with regards to the Revolve would probably be small, trimming the position if I even choose to do that much. I do believe that the business is on an upward trajectory from here. Management on the call and in their guidance definitely echoed those sentiments. I'm not decided yet whether I will trim my position in Revolve and add to more Tesla and SoFi. Likely I might just add net new cash to add into those positions. I'm definitely not adding more Revolve at this point. I'm quite happy with my allocation of where Revolve sits in my portfolio. But as always, for any moves that I make, I'll probably tweet about them in real time as I make them. For right now, this is the Fundamentals Investing Podcast. I know this video is not a SoFi video, but I hope you enjoyed it regardless. Thank you so much for listening.